Hi guys, I hope you are well. Welcome to another lesson. And what I wanted to do today is just continuation of the central bank dealers range. And I'm talking to you today in real time price action. We're going to talk about the back end of last week with this particular time method here. But what you see right now is real time price action. The reason I'm doing it in this format for you guys today is it's very, very simple. In a real life situation, well, let me rephrase. The last lesson we did was recorded, and I took a very good example of what the central bank dealers range and the standard deviations should print like. In that you get the high or low between the London session and you get your distribution in the New York session, vice versa, and all that kind of thing. Every single day, price action can be different. And I need you to understand that not every day is going to be perfect, because some days are going to be slightly different. Now, you need to be prepared for different price action to print, because the markets, they're not random as such. We work on probabilities, but every single day you don't get the perfect central bank dealers range, and you need to understand what is going to potentially happen if a different situation was to arise. I want to point your attention to Thursday between the hours of 7 p.m. and 1 a.m. UK time. This is the price action that this algorithm is referring to, which is going to be utilized in order to find the next day's range. Now, it doesn't always work like this, and in the last lesson we spoke about the conditions that need to be met. We spoke that the ideal conditions are between 20 and 30 pips, but no more than 40, no less than 10. If we measure this high all the way down to this low, you'll see it's about just under 12 pips. That is kind of fine, but we can use it. I'd like you to ignore this for now on the top right of the screen. We're just focusing on this, because basically anything over 10 pips, I'm using it. I'm using it as a reference guide. So we can see that we had a bunch of consolidation all the way up until 1:30 UK time, which is 8:30 New York time. And you can see there clear move up here to this pink box, and then a clear move down under all of this liquidity that you see right here. You should also note that apart from this central bank dealers range, from the New York session all the way up to the London session, we created relative equal highs. And this liquidity down here is relative equal lows. So prior to these two liquidity sweeps, we had liquidity both sides. So no matter what type of condition is printed within this algorithm, there is no trading opportunity up in the London session, because there's liquidity both sides. You've got liquidity here, which could be a target. That's buy side liquidity. You've got liquidity down here, which could be a target. That's sell side liquidity. But also, we had this piece of volatility injected into the markets, and then we had a sweep down. Pardon me. So now we need to work out why this happened. Well, what I want you to focus on is the timings of when this happened, because that is when we had a news release. That was NFP. So if you're ever wondering why consolidation happened prior to this time here, that's because we had NFP, and there was not a lot of chance of volatility between really probably Thursday all the way up until this news event here. And you can see that as soon as we had the news event, price did what it was pretty much supposed to do in the form of sweeping above this liquidity, sweeping below this liquidity, distributing and selling off again. This pink line, or purple line, sorry, is an area of interest. And as you can see, the algorithm took price action all the way up to this area and dropped off again. And if we go to a daily time frame, that's the area I'm referring to. This area of sell side imbalance. And then obviously into this breaker block as well. And then to keep things super, super simple, we are selling off currently. So there's every chance that the target is that liquidity right there. Which brings us back to this piece of price action, which was created on a smaller time frame. How could we have been a part of this price action? Ignoring the fact that it is NFP, let's just pretend this is any news event, because NFP is a news event. You certainly shouldn't trade prior to, and you should really give it about half an hour after it if you do insist on trading it. I don't tend to trade it. Okay, I don't tend to trade it, especially at the later part of the week. But this is price action that can happen anywhere. So I want to use it and show you guys how powerful this whole thing is. So we know price went into this daily sell side imbalance. We know price sold off. How can we utilize the central bank dealers range as an extra piece of confluence that we could find something within this area? Well, now we're going to measure our standard deviation range and we're going to see exactly what happens. So all I'm doing is I'm dragging the box down and pushing it up again. That's one standard deviation. This is two standard deviations. And then this is three standard deviations right here. And then as you can see, we are within the realms of the fourth standard deviation. Within the realms of standard deviations, as I mentioned in the last video, you do not want price to exceed 4 standard deviations. If it does, you ignore price action completely. The ideal sweet spot is between 2 and 3 standard deviations. 1 standard deviation is perfectly acceptable, but the perfect piece of price action is between 2 and 3. 4 is okay, but you don't want it to exceed 4 standard deviations. The 4th standard deviation has its purpose, which is to basically show you extended price action. You can see the NFP pushed price all the way up to this 4th standard deviation, but not any higher. That is not random. You can see that the body, or the 2 bodies here, respected 2 standard deviations. So this piece of price action here, this wick, which is a gap in price. Okay, the bodies are important. The wicks definitely tell a story, but it's a gap. This is where price traveled to, but it closed here. The wicks came into the point of interest area. When that happened, it pushed within the standard deviations, but the bodies closed within 2 standard deviations. This is a really nice price action. We've utilized the central bank dealers range as an extra piece of confirmation. We're going to start referring to midnight New York, which is 5 a.m. UK time. That is the opening price. Where is it? That is the opening price that the algorithm refers to. 11 p.m. UK time is when the candle prints a new daily candle. It's when the daily candle prints again. The algorithm essentially ignores price action up until 5 a.m. UK time, midnight New York. That is the algorithm which is we're going to utilize as the opening price. That's called the true open of the daily range. Okay. It is called the true open of the daily range. Write that down. Price pushed all the way above it. When you see price is above it during a high news impact event, that is your first clue that sells are more likely than buys. If you are below it during a high impact news event, that is your clue that buys are more probable. But we have to understand alignment with structure, because we can see here at 130 we came below it, but it also came above it after opening price as well. This was one candle. This is the news candle, but price created a bearish movement outside of this whole thing from an area of interest on a higher time frame within 4 standard deviations. After price created a sell-off and broke market structure and swept above this relative equal highs, which is a buy-side liquidity, price created what we spoke about in the very first session of this new module when we spoke about areas to enter off of. And this is a balanced price range. So you can enter inside that balanced price range because you've utilized a higher time frame point of interest level. You've utilized the standard deviations within the central bank dealers range. You've gone from the daily time frame all the way down to the 15-minute. You can enter in the 5-minute as well. And this is giving you an entry. And also, if we measure the range that got created, and before we do that, let's just determine the range. We have this candle right here. On the other side of it, we've got this one, which is lower, and then we've got this one down here, which is way lower. That is your 3 candle formation. So this is a valid high. The valid low is here because we've got a candle which is lower than this candle and the candle on the other side of it. So now we have a valid trading range. So we can measure the entirety of this range. And you can see the price reacted at the 71% level, actually reacted near the 78.6% level. Regardless, it came into this area here, which you should be boxing out as your optimal trade entry level area. Now I can delete my fibs to keep things a little bit tidy. You could have entered when price closed down here because you've got the confidence to see that you've got the trading range, which has reacted at 4 standard deviations and then sold off, created a bearish range inside a higher time frame point of interest level area. Balanced price range. You can enter inside the balanced price range. You can enter at the 71% level. You could enter when price comes back down here and closes, because price isn't going to attack that high again. We've already had NFP. We've had the crazy volatility and it's done what we need it to do. But if we look at where this candle also printed, you can see that price came into this 5-minute FU candle / order block. Again, not random. Huge close of price action down here. And here's another really cool entry. Because this candle, this is a gap in price action. This particular candle created price to push higher, came all the way back down and sold off again. This piece of price action here came back into this order block. You could have entered there with your stop loss above here, because this liquidity grab is very unlikely to happen again. That could be an aggressive entry, but that, when you get more time and experience, that can be your entry. And you could literally be entering in here with your stop loss right about here, and you could just be targeting this low right here. 5 to 1. Or you could have entered right at the top here, or inside this area of balanced price range. It's completely up to you. This is just showing you how powerful and how good the central bank dealers range with the standard deviations can be. And as I mentioned, this is not permission for you to use them solely without the other things. You need market structure to be in place. We had liquidity. We had a higher time frame piece of interest. We had our balanced price range entry level. We had our OTE level. We had our target. We had all the things in place that we needed before anything else was going to happen. So now you have that piece of information. You can use it. What I want to talk about next is the price action we are seeing right now. And to make it just super, super simple, I'm just going to delete the older price action from the other day because I don't want this to confuse you or anything like that. I'll keep this one here because we can see the standard deviations. Now, this box, I'm just going to double click. This is the indicator. It's called ICT everything. Okay, I haven't done anything to the inputs. So you can pretty much download this. If you want to screenshot this, or you want to pause it, then, please feel free to take it. And in fact, I'll screenshot all of this for you just in case, but you shouldn't have any issues. It's going to mark out my daily price, which is there. This line here is the opening of today. Now, as we can see, we've got a suggested standard deviation. They're asking for the flout, not the central bank dealers range, because they've worked out the central bank dealers range is about 13 pips. If it's under 20 pips, according to this indicator, it's going to ask for something called the flout, which is basically the Asian range and the central bank dealers range combined. Now, just for context, if I come down to this here and I play with this and I offset the central bank dealers range and I use the flout instead, it's going to change. And it's going to change dramatically. As you can see, it's picked up the Asian range or an Asian range. I'm not a massive fan of the flout. I think the best thing you can do is utilize the central bank dealers range, untick the flout completely, and basically if it's any less than 10 pips, just ignore it. The central bank dealers range is what the algorithm refers to. It does not refer to the flout. I don't know who made this up. I think this was one of ICT's lessons where he got a bit carried away, because in my eyes, the flout doesn't really work as well. Now, as you can see, price is selling off. Does that mean we're going to be in for a bullish day today? Does that mean that low of the day is going to be created here? But overall, we're bearish. We're looking for sells. So if we look at this, so this is real-time price action. This is stuff that's happening right now. If we go to maybe a higher time frame, let's just see what the potential is. Okay, we've got 3 hours until this particular candle here closes. We've got this target here for liquidity. We could definitely sweep above this liquidity here because that would be yesterday's high. But we've got this imbalance which is currently forming. We've got this candle to close off on. We've got this price action which is just dumping to the downside. It's not really anything to scream or shout about. I can see relative equal highs. I'd rather price potentially went back into this range here. But what we can do is utilize, I've just drawn a box around this central bank dealers range. We can utilize the standard deviations. We can see what is likely to happen. So we don't want price to go any lower than 4 standard deviations. So this is a useful tool to find out when are we likely to get a retracement back, because I'm not interested in buying at the moment. We've sold off to the downside. Buys wouldn't be fruitful. But what we can do is try and understand when this bearish sell-off is going to finish. And let's see if we could come into this area of imbalance and this area of imbalance as well, as long as this candle closes. So if we start retracing back, I'm utilizing today's central bank dealers range to basically give me a bit of a hint as to what could potentially happen. Now, we have got relative equal highs forming. We haven't got any news today, but if price was to sweep above this area and then sell off again, I could utilize the standard deviations to see if it goes to the bullish side. I'm looking at this area here and I want to see where we are during the New York session, because that's going to tell me a lot. That's the opening price the algorithms are referring to. But now I'm looking at this standard deviation. I'm looking at this central bank dealers range. I'm also looking to see when this is likely to finish. I'm bearish overall. I'm bearish from this area here. If you mark out 7 a.m. as well as 5 a.m., you usually will get price action making a run for it away from the Asian session range. If that's going to happen, it usually means it's running to something. It's going somewhere. If price was to have just consolidated in this area here, then there's going to be a run on liquidity later on, probably around the New York session. So the London session's definitely given us something here. But we need to find out when this is going to end. So when I get to the New York session, if we do start pushing higher, we can utilize this and say, yeah, that was where we could have potentially seen it happen. But if we look to our left on a higher time frame, I don't really see anything which is of that much interest to me other than maybe this order block. But I'm bearish overall. My higher time frame areas of interest happen to be around this current area. I say current because this candle isn't finished. This current area of imbalance and above this liquidity here. So now would rather price come into here. But then if we look at this piece of price action up here, this is the opening price. I would rather sell above the opening price, which means I need price to come a lot higher. I need price to come into this area, which basically means I'm not interested in this area of imbalance. What I'm doing now, guys, I'm talking to you in real time. I'm analyzing price action right now, thinking about when I'm going to take my setups, what I'm looking for within price. And the fact that there isn't any news today and the central bank dealers range is not really doing a lot, and it's 12 pips, we've got liquidity above it. We haven't made a run for that liquidity. We've made a run lower. I think this is just selling off. I feel like this is going to create more manipulation. I would be particularly interested in price action coming into this order block right here, which is a 15-minute order block. And if we utilize the standard deviations, that would be one standard deviation above this area here, above opening price. So I'm utilizing the sell-off to see when price is likely to stop. It's very, very unlikely we're going to carry on selling off without some form of retracement. So we're utilizing now how likely these ranges are likely to carry on for. That's what I'm doing with this piece of information. Okay, that's what I'm doing with this piece of information. It's unlikely to move lower than 4 standard deviations. If it does, and it can happen, it does happen, but if it does that, then today is definitely a no trading day. So this is typical Monday price action. This is what you get. But I wanted to do this lesson to just show you the realism behind it. And just so you can be aware of it. So again, your homework is really just to get used to this piece of price action, get used to marking out these ranges, and get used to just marking out standard deviations. Go 4 sides either side of it. And you can usually see around these boxes where are these areas likely to move and turn from. There isn't really anything on this side that I'm interested in. I'm just using it now to see where the range is likely to end before it makes a retracement to carry on selling off. Because I'm utilizing the higher time frames. And we are still working our way out of this area of imbalance right here. hopefully you enjoyed this lesson. Hopefully this has put a little bit more clarity towards central bank dealers range for you in a bit more of a realistic setting. And we will reconvene and speak again at the next lesson. Take care, guys, and I'll speak to you all very, very soon.